Right now, the market seems to have this split personality. On one hand, some of the most reliable long-term indicators are flashing bright red, basically warning of danger ahead. But on the other hand, the market itself seems completely calm. It's a huge paradox, and it could define the next few years for investors. So let's try to make some sense of it.
So, this is the central question, isn't it? The market is telling us two completely different stories at the exact same time. So which one do you believe? Is one of them just flat out wrong? Or are we all maybe missing a piece of a much bigger picture here?
Yeah, this really lays out the conflict perfectly. You've got one side, the historical data, that's practically yelling at us that the market is way overvalued. And then you have the other side, the current mood of the market, which is basically saying, hey, don't worry, everything is totally fine. So let's kick things off by digging into those warning signs first. All right, so first up, let's look at the cautionary tale. We're going to dive into two really powerful indicators that historically have had this uncanny knack for spotting bubbles right before they pop. Okay, the first one is a biggie. It's a metric made famous by Warren Buffett himself. In fact, he once called it the best single measure of where valuations stand at any given moment. The easiest way to think about it is like a price-to-sales ratio, but for the entire country. It compares the total price of the stock market to the sales generated by the U.S. economy, or, its GDP. So, where does that indicator stand today? Well, anything over about 120% is historically considered a red flag. Today, that number is a staggering 217%. That's not just a little overvalued, that's an all-time high. It suggests the stock market's value has almost completely detached from the real economy it's supposed to be reflecting. Now, a number that high is just a number, right? Unless it has a track record. And that's what's so compelling here. Before the dot-com crash, it peaked around 160%. Before the 2008 financial crisis, it was over 100%. And just before the 2022 downturn, it hit 202%. Each and every time, a major correction followed. And today's reading, it's higher than any of those. But, of course, it's not quite that simple. Nothing ever is, right? Critics point out some pretty serious flaws. For one thing, U.S. companies are global now. They earn about 40% of their money abroad. That boosts the stock market, but it doesn't get counted in U.S. GDP, which kind of makes the ratio look artificially high. And, even the man himself, Warren Buffett, has kind of backed away from relying on any one single indicator. Okay, so maybe the Buffett indicator is an outlier. What if we check another trusted long-term metric? Let's look at the Shiller PE, also known as the CAPE ratio. This one is really designed for stability. Instead of just using 1 year of earnings, it smooths everything out by averaging the last 10 years. The whole idea is to get a clearer picture of where valuations truly stand, away from all the short-term noise. So what is this more stable picture telling us? Well, the historical average for this ratio is about 17. Today, it's sitting at nearly 38. I mean, that's more than double its historical average. In the entire history of the U.S. stock market, we have only seen valuations this high 2 other times, right before the Great Crash of 1929 and at the absolute peak of the dot-com bubble in 2000. That's some pretty scary company. Now, here's the thing about the CAPE ratio. Its real power isn't about predicting when a crash will happen. It's about forecasting long-term returns. And the relationship is crystal clear. When the CAPE ratio is low, the next decade usually brings fantastic returns. But when it's high, like it is right now, history tells us to expect a long period of pretty disappointing, lower than average returns. And just like the Buffett indicator, the CAPE ratio has its fair share of critics. They'll tell you it's like trying to drive by looking only in the rearview mirror. It's using old data to predict a future that could look totally different. And critically, it is a terrible tool for market timing. A high CAPE can stay high for years, and anybody who sold out in the mid-90s based on this missed one of the biggest bull runs in history. So, okay, we've got 2 legendary indicators, both blinking bright red. Case closed, right? We should all be running for the hills? Well, not so fast, because if we flip the coin and look at what the market is feeling right now, we get a completely different and much calmer story. Let's talk about the VIX. It's often called the fear gauge. All it does is measure expected volatility. So when investors get nervous and think the market's going to start making big swings, they buy protection, and the VIX goes up. When they're feeling calm and confident, the VIX goes down. It's basically a real-time snapshot of the market's pulse. So what's that pulse right now?
After all those historical warning signs, you'd think fear would be pretty high. But it's the exact opposite. The VIX is at just 14.43. Now, to put that in perspective, any reading below 20 signals a calm, stable market. This number suggests investors aren't just calm, they're borderline serene.
And to really see just how calm things are, you have to compare it to times of actual chaos. During the 2008 meltdown and the 2020 crash, the VIX absolutely exploded, rocketing past 80. Today's reading isn't even playing in the same league as that kind of fear. It's not even in the same universe.
And this, right here, is the core of the whole puzzle. We have these sky-high valuations, which have historically been a huge red flag, but they're paired with rock-bottom fear. So what on earth happens when these two opposites meet? Okay, so let's just put it all together on one screen. You have two of the most reliable long-term indicators signaling major danger. But the market's real-time mood indicator is signaling total calm. It's like the market's long-term rational brain is screaming danger, while its short-term emotional heart is just humming along without a care in the world. And that raises a critical question. Which one is actually in control?
And that leads to this really unsettling idea. What if the calm is the real danger? There was this economist, Hyman Minsky, who had a theory that long periods of stability and low volatility, which is exactly what the low VIX is showing us, can actually make investors complacent. We get careless, we start taking on more and more risk, pushing prices even higher, and we end up planting the seeds of the next crisis ourselves. So, with all these conflicting signals, what are we supposed to do? Look, the goal here isn't to perfectly predict the future. It's about building a framework so you can navigate these pretty uncertain times in a rational way. So how do you actually put this all together? Well, it probably boils down to a few core ideas. First, you just have to understand the risks. History is very clear that starting from high valuations usually leads to lower future returns. Second, you got to stay disciplined. Remember that none of these are perfect market timing tools. And finally, think of these indicators less like a crystal ball and more like a compass, something that just helps you understand the risk in the environment around you. Ultimately, when you combine the sky-high valuations with the super low fear, it all points to one thing: a market that is priced for absolute perfection. It's assuming everything goes right: a soft economic landing, great earnings growth, no major surprises. And that leaves us with one last crucial question to think about. In a world that's anything but perfect, what happens when something finally goes wrong?